Once gold breaks free into a new all-time high and stays there, institutions pile on, retail piles on, people will start looking at silver because once gold gets to a certain level, and it's different for everyone, but we'll just use a round number, say 25, 2,600 US, and silver is still sitting there at, 25. People can say, you know what, silver looks like a lot better deal. And once silver gets to 30, 31, 2 in US terms, that premium I talked about goes away. And everybody's sitting at a profit. Might be a meek one. It might be $2 profit. It might be a $1 profit. It might be a break even. But people will hold. It'll be like the cryptos.
It's time for some very difficult conversations about silver. On Friday, gold prices rallied to a fresh all-time high above $2,180 as yields on 10-year U.S. bonds fell to 4.04% after the release of the U.S. non-farm payroll data. A sharp decrease in wage growth and a higher unemployment rate have increased the market's optimism that the Federal Reserve will reduce interest rates during its June policy meeting. The increasing optimism has had an immediate and obvious effect on asset prices. The S&P index has hit and sustained new all-time highs above 5,000, and so has Bitcoin, which is now trading near all-time highs. More importantly, gold hit all-time highs for the second time since early December, yet there haven't been any notable increases in silver's price. While gold is trading near all-time highs at $2,179.25, silver is trading at $24.32, the highest price recorded over the past few months, but nowhere near all-time highs. Historically, gold and silver prices have had such a well-established correlation and have rarely deviated from one another. In fact, silver has been known to outperform gold briefly during bull markets. So one would expect silver to be trading much higher than it is today. Yet, the metal is trading well below its all-time high. According to David Morgan, a renowned metals analyst and publisher of the Morgan Report, the recent activities in the gold and silver market are irrefutable proof that the manipulation of the smaller metal runs deeper than one can imagine. Morgan believes this obvious manipulation of silver prices by the banks is making the asset very repulsive to buyers, except for some die-hard holders and those buying for industrial uses. Unfortunately, the people in the first category are getting scarcer. Those in the second category are increasing daily, but they will benefit greatly from low silver prices and have the resources to keep prices really low. So, does this mean silver prices will stay down permanently? Morgan believes not. In a recent interview with the Goldcore TV, the popular financial analyst discusses his outlook on silver prices, carefully analyzing why silver should be trading much higher and what must happen for prices to go higher. We will now bring you clips from the interview, but before we do, please help us reach more viewers by giving this video a thumbs up, sharing it with others, and subscribing to the channel. You can also activate the notification bell to be instantly notified whenever we upload a video. Thanks for your support and enjoy the video.
If you look back at silver's history and gold's history, and you go back thousands of years, the highest gold-silver ratio ever got was 20-1. And most of the time it was below that. It was 16-1 by mandate when it was deemed by Sir Isaac Newton in England way back when. It was near the natural ratio back in Mesopotamia, Egyptian times. And the point is that, and I thought about this, it's the obvious, but it took me a while to think about it. Gold and silver had a ratio of pretty close to their natural ratio for thousands of years. And why? And the answer is because they both served exactly the same function, money. So when silver was only money and gold was only money, the two monies had a relationship that was pretty close to their natural state out of the ground, the gold-silver ratio from the earth. Now, when silver was predominantly the money in the United States, because we were basically put on a silver standard, not a gold standard. And then, of course, the bankers did their magic, which is outlined in the Wizard of Oz. It talks about the golden road to the Emerald City, which is the Bankers Hall of Fame. And Dorothy had the silver slippers to click the silver slippers and come back home and go back to silver. But I won't go too far down that road. The idea that silver isn't money started way back in 1873 with the crime of 1873. And silver was demonetized. So now you've had that bifurcation. And that bifurcation is silver isn't treated as money by the establishment. remember, as much as you hear gold is, doesn't pay interest, gold is a static investment. You dig it out of the ground, bury it from being buried, and you bury it in a safe, and all the negativity you hear around the gold market, central banks are still buying it up, left, right, and center. China has moved significantly in the gold market over the last 2 decades. Russia has a good gold supply. So gold is mainstream, even though you won't hear that from many people but myself and others like you.
Hmm.
And yet it's not acknowledged as mainstream. But the bankers look at gold. So they went to a gold only standard way back in, let's say, the 1900s and slowly phased silver out of the monetary system. So if you go back to the early 70s, when we had the first bull market that I participated in, so I'm not saying the first bull market, I'm saying the first one I participated in, we're off the silver. We were on a silver standard, but silver still circulated through 64. 65, they stopped minting silver-based coinage. But in the early 70s, everyone knew that, not everyone, but most people knew that silver was money. I mean, it was our quarters, it was our dimes, it was our half dollars. It's money. So when the first bull market started, and you couldn't own gold until I think it was 72 or so, silver was the place to go. And so all the vending machines back in those days, we actually pulled handles, most of them mechanical, and all these physical metal discs were going in there of 90% silver. So the vending industry just gobbled up all that silver because it was far more valuable than the face value. So it left the market. It was, the law of Gersham's law about, good money hoarded and bad money spent. So, and I'm giving a long answer, but the decoupling is what's been doing it. Because if silver were treated as money, and I did a lecture on this a few years ago, there would be a different ratio. It would be more toward maybe the classic monetary ratio that was edict. It's not the natural ratio, which is 15, 16 to 1. The natural ratio used to be 12 to 1, but we've mined so much silver out of the ground, it's now 7 to 1. And yet we're at a gold silver ratio of like 85 to 1 right now.
Mm-hmm.
It doesn't make much sense if they're both treated as money.
Over the past few years, the whole narrative around investing in silver has gradually shifted. The metal has gone from being considered a purely monetary metal to being viewed as both a monetary and industrial metal. But at the moment, silver is almost purely considered an industrial metal. Some experts even compare it more to copper than gold. According to Morgan, this is the exact reason why the metal is not performing as expected, because the narrative around investing in it has changed. So, for anything to change for silver prices, we have to return to the old narrative by appreciating silver's status as both a monetary metal and one with incredible industrial uses. In addition, Morgan explained that institutional investors have to start buying silver. When they start buying, prices will rise, and other investors, especially the embattled retail investors, will at least break even on their investments and start buying again. Let's get back to the interview.
Problem that the bankers have with silver not being money and pounding that drum is that the industrial side is so strong that side alone could take over the gold silver ratio and start moving in silver's favor. I say that because the projections for solar usage going forward for the next few years won't eat up all the silver, just that, but the industrial side will eat up more and more. You go back 2 decades, the industrial use of silver was 35% of the market. Now it's 55% of the market, moving toward perhaps 65% of the market. You go back 20 years when we mined 550 million ounces of silver. Now we mine 850 million ounces of silver. So think about what I just said. We used about 35% of the market when we only mined 550 million ounces. Now we use pushing towards 65%. And we were using, only mining 550 million ounces today as a thought experiment. That 65% would be almost the whole silver market. So how do you make silver jewelry? How do you have silverware, and what's left for investment? My point being is that we could have a natural squeeze coming into the market, because as the supply chain gets tighter and tighter, all these producers that use silver industrially will see the squeeze. And so they'll start to move into buying silver ahead of time so they can't go out of business. So once you have the Tesla, the 3M, the Mitsubishis, I mean, all these great silver users look and see, oh my goodness, our silver inventory is down to normal where we resupply. But my logistics guy just told me, hey, it's a month and a half out before we can get our supply. They won't go into a panic, but they'll go into a semi-panic. So once they start to build inventory back, and the missing key, of course, is more importantly, what I said earlier about silver not being an investment metal for money. What's lacking in this so far in the last couple of years has been institutional participation, which is pretty mind-boggling. Because if you go back to 2020, there was a guy named Scott Maynard who was at Davos, now known as the World Economic Forum, or better known as that. And Bloomberg interviewed him and asked him what was his go-to investment in 2020. He said silver. And if you look what happened in 2020 with the silver market on the institutional side, 320 million ounces of silver were bought through the ETFs. And you haven't seen anything close to that over the last couple of years. And yet gold continues to be just pounded. Gold has, been bought and bought and bought. Mm-hmm. Silver hasn't gone along for the ride. So I would say, I'm not blaming anyone. You asked my opinion. It's really the institutional side of the banking sector. I think the bank, this is conspiracy. I'll just say it because, oh, David, my thoughts are, why aren't the banks or the institutions moving into the silver market? The algorithms work just as good for silver as they do for gold. And they know they could get a pretty good pop. A $3 move on a $20 investment's a pretty good percentage. Mm-hmm. And they want to take advantage of those. And we've had several of those in the last couple of years, both up and down. And so why aren't the institutions? And I think, now this is again kind of on the periphery, that maybe the word's out, hey, let's just continue to pound gold, and let's just leave silver by itself. Because you see drainage out of the physical supply you don't normally see when you've got gold making highs. You see the ETFs being depleted. You see the LBMA, offing physical silver, and you see the COMEX going from what was 150 million ounces down to as low as like 35 million, and now I think it's at 42 in the registered category. So where's all that silver going?
According to recent data from the Silver Institute, there continues to be strong demand for silver from industries, but very little demand from the investment side, outside a little bit of sustained interest from retail stackers. Morgan believes these stackers will continue to persevere because they know the real value of silver, especially in today's world of fiat currencies getting so rapidly debased. However, he adds that they won't have to hold on for much longer because the industrial interest and diversifications from gold will spur price gains in silver in no time at all. These price gains will be significant enough to encourage more buying, which will spur further price gains. Please share your thoughts on Morgan's interview in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.